Hey there, traders. John Caruso coming to you for the afternoon of May 25th with a quick look in on the market today. A couple things I'm looking at right now. One of the things standing out is the present level of the 10-year yield trading at 1.57%. We're at a 4-week low right now. And that's even on the back of an accelerated housing price index that came in up 14% on a year-over-year basis. And following that number, we did see a sharp decline on a month-over-month basis in the pace of new home sales, down 5.9%. So what that's telling me right now is, despite the low levels of interest rates, home buyers are being discouraged by the value of homes, the accelerated pace that we've seen home values increase over the last year over year. So it doesn't matter where interest rates are. The buyers are starting to slow down just based on housing prices right now. So what that's telling me is interest rates are too low. The Fed policy right now is totally inappropriate with where things are headed right now from an economic standpoint. Even if you look back at the financial crisis in '08, QE purchases were running at $80 billion a month. Right now, we're running at $120 billion a month. That's split between mortgage-backed securities and treasury bond purchases by the Fed. So totally egregious, totally inappropriate, we think, at the present moment. I think there's an imbalance there in the market based on where interest rates are and where housing values are headed. We do think that you are going to start to see those slowly come back into line in months ahead. And for the 10-year yield to rise, to 1.75, even as high as possibly 1.9 over the next several weeks, we think is entirely possible. And here's why. If we do have a solid headline jobs number come June, we see sharp revisions from the massive miss that we saw at the beginning of May that missed headline expectations by 700,000. You could start to see the bond market move once again back to the downside, interest rates to the upside. And then following that jobs number, a week later, we get the May CPI number, where we think we're going to see another accelerated number in May CPI in terms of consumer price inflation. So keep that in mind. We'll see if I'm right, but I do think the current levels of interest rates is unsustainable. There is an imbalance in the market, and I think you can expose it. So we'll see if I'm right. Once again, I'm John Caruso. Feel free to reach out if you have any questions. Take care.